Berkshire Hathaway costs $640,000 per share. Apple, just $230. So obviously Berkshire is worth way more, right? Wrong. Apple is actually 5 times larger than Berkshire. That probably doesn't make any sense right now, but by the end of this video you'll understand exactly why, and you'll never look at stock prices the same way again. Today we're covering 3 concepts that every single investor must know: shares, market cap, and dividends. Let's start with a simple story. Your friend Sarah opens a pizza shop. Business is great, the whole place is worth $100,000, but she wants to expand, open a second location. She needs $50,000 and the bank won't lend it to her, so she comes to you and your friends with an idea. Sarah splits her business into 1,000 shares, each worth $100. She sells 500 shares to raise that $50,000 and keeps 500 for herself. You buy 100 shares for $10,000. Now you own 10% of everything: the ovens, the brand, the recipes, and 10% of all future profits. That's what a share is, a tiny piece of ownership in a business. When the shop makes money, you make money proportionally. Real stocks work exactly the same way. Apple has 15.2 billion shares floating around. When you buy 100 shares at $230, that's $23,000 invested. You own a tiny fraction of the company. It sounds small, but that tiny slice entitles you to a piece of every iPhone sold, every Mac shipped, every subscription payment. You even get a vote at shareholder meetings. And here's the best part: Apple pays you cash every single quarter just for holding those shares. More on that in a minute. Quick clarification: people often ask what's the difference between shares and stock. Technically, shares means a specific number of units, like I own 100 shares. Stock is more general, like I own Apple stock. But honestly, everyone uses them interchangeably, and that's perfectly fine. Don't let anyone make you feel like there's some big difference. There isn't. Now let's move on to why share price can be incredibly misleading. Now we're getting to the most important concept in this video: market cap. This is the #1 thing beginners get wrong, and it leads to terrible investing decisions. If someone tells you a $10 stock is cheap and a $1,000 stock is expensive, they don't understand market cap. Let me show you exactly why. Think of it like pizza. You've got 2 pizzas, both the same size, both worth $20. Pizza A is cut into 4 huge slices, $5 each. Pizza B is cut into 100 tiny slices, 20 cents each. Which pizza is more expensive? Neither, they're both $20. The slice price, $5 versus 20 cents, tells you absolutely nothing about the size of the pizza. Stocks work the exact same way. The share price is just the slice size. Now let's go back to our opening question. Apple, $230 per share times 15.2 billion shares outstanding equals a market cap of $3.5 trillion. Berkshire Hathaway, $640,000 per share, but only 600,000 shares equals $780 billion. Apple is 4.5 times bigger than Berkshire, despite having a share price that's nearly 3,000 times cheaper. This is why market cap matters and share price doesn't. Here's the only formula you need. Market cap equals share price times shares outstanding. That's it. Companies are grouped into 5 categories by market cap. Mega caps are over 200 billion, think Apple, Microsoft, Nvidia. These are the giants that drive the global economy. Large caps are 10 to 200 billion, established companies like Netflix and Goldman Sachs. Mid caps, small caps, and micro caps get progressively smaller and riskier. If you're just starting out, stick with large and mega caps. They're the safest place to learn. Here's the trap that gets beginners. Stock A costs $500 per share. Stock B costs $10. Your friend says buy stock B because it's cheaper. But stock A has 1 million shares, market cap 500 million. Stock B has 10 billion shares, market cap 100 billion. The so-called cheap $10 stock is actually 200 times more expensive than the $500 stock. This is the #1 mistake beginners make. Whenever someone says a stock is cheap or expensive, ask them, cheap compared to what? Always check the market cap, never just the share price. Now for the fun part: getting paid just for owning stocks. Imagine if your landlord sent you a check every 3 months just because you live in the apartment. Sounds crazy, right? But that's essentially what dividends are. Companies share their profits with shareholders as a thank you for being owners. Let's see how it works. Let's use a real example. Coca-Cola stock costs about $77 per share and pays $2.12 per share in annual dividends. That's a 2.8% yield. If you own 100 shares, that's $7,700 invested. Coca-Cola pays you $212 every year. That's $53 deposited into your account every 3 months like clockwork. You didn't have to do anything. You didn't sell any shares. The company just sent you money for being an owner. That's the beauty of dividends. Some companies are so committed to paying dividends that they've raised them every single year for decades. They're called dividend aristocrats, companies with 25 or more consecutive years of dividend increases. Coca-Cola has raised its dividend for 54 straight years, Procter & Gamble 68 years, Johnson & Johnson 63, think about that. Through the dot-com crash, the 2008 financial crisis, COVID, these companies never stopped paying, and they raised the payment every single year. That's the kind of reliability money can't buy. Now here's where dividends get really exciting. Instead of spending your dividends, what if you reinvested them, use that cash to buy more shares? It's called a DRIP, dividend reinvestment plan. Step 1, your 100 shares pay you $212. Step 2, you reinvest that and buy almost 3 more shares. Step 3, now you have 103 shares which pay an even bigger dividend next year. And you just repeat. More shares generate bigger dividends, which buy more shares, which generate even bigger dividends. This is compound growth, money making money. Let me show you what this looks like with real numbers. Here's real data. $1,000 invested in Coca-Cola back in 2006. The red line is price only. Your stock grew to about $3,200 thanks to price appreciation and a 2-to-1 stock split in 2012. Not bad, you tripled your money. But the green line, that's what happens when you reinvest every single dividend. About $6,000, nearly double the price-only return. That extra $2,800 came entirely from reinvested dividends buying you more shares, which earned more dividends year after year. This is why Warren Buffett says his favorite holding period is forever. Time plus reinvested dividends equals real wealth. Here's something most beginner videos won't tell you. Dividends aren't free money. When Coca-Cola pays its 53-cent quarterly dividend, the stock price drops by exactly 53 cents on the ex-dividend date. You had $77 in stock, now you have $76.47 in stock plus 53 cents in cash. It's a wash. The real benefit comes over time. As the company grows, both the stock price and the dividend increase. But don't buy a stock the day before its dividend thinking you'll get free cash. The market isn't that dumb. Now, should you buy growth stocks or dividend stocks? Amazon has never paid a single cent in dividends. They reinvest every dollar into warehouses, Oz servers, and new businesses. $1,000 invested in Amazon in 2010 would be worth over $20,000 today. Coca-Cola, on the other hand, grows slowly, but pays you 2.8% every single year in real cash and has done so for 54 years straight. Which is better? Honestly, neither. They serve completely different purposes. Growth stocks build wealth over decades. Dividend stocks pay you income now. The smartest investors own both. And here's the best news for beginners. You don't need thousands of dollars to start. Every major brokerage, Fidelity, Schwab, Robinhood, now offers fractional shares with 0 commissions. That means you can buy $1 worth of Apple. You'll own 0.004 shares, but it's real ownership. As Apple grows, your dollar grows. When Apple pays a dividend, you get your fraction. The idea that you can't afford to invest in the stock market simply doesn't exist anymore. You can literally start with $1 today. Let's lock in the 3 things you need to remember. Number 1, a share is a piece of ownership. When you buy stock, you own a real piece of the company. Number 2, market cap is the true measure of size. Share price times shares outstanding. Never judge a stock by price alone. A $10 stock can be bigger than a $1,000 stock. And number 3, dividends are real cash payments companies make to you, the shareholder, just for holding the stock. These 3 concepts are the foundation of everything in investing. If this video helped you understand shares, dividends, and market cap, smash that like button, subscribe, and share it with someone who's just getting started. New videos every week. See you in the next one.